Welcome once again with the new question of accounting ratios for paper 2018 supplementary Punjab University, and it is the last question which is available to solve related to accounting ratios. So 2019 question is already solved in the previous video. So one question that was for 2018 was missing, 2018 supplementary. So here is the solution of this question. So following is balance sheet of Nazir and Company as on 31st December 2004. Extract of balance sheet is given here. On the left hand side you can see liabilities, and on the right hand side assets are given. So current ratio, liquid ratio, debt to equity ratio and proprietary ratio are asked to be solved. So first of all, current ratio is equals to current assets divided by current liabilities. Current assets are those assets which can you receive within 1 year, and current liabilities are those liabilities those should be paid within 1 year. So current assets are your stock, bill receivable, debtors, prepaid expenses, cash at bank. All these are your current assets. And on the other hand side, if we talk about current liabilities, so income tax payable, bills payable, bank overdrafts and creditors, these are for your current liabilities. So calculation is also given here. Current assets are 105,000 and current liabilities are 20,000. So just simply divide these two and result is 5.25 ratio 1. That is the answer of your current ratio. After that, liquid ratio, many times we already calculated this, and that is equals to liquid assets divided by current liabilities. Liquid ratio and quick ratio both are same. So if we talk about quick ratio or we talk about liquid quick assets or we talk about liquid assets, both are same. So liquid assets are equals to current assets minus stock minus prepaid expenses. So current assets are already calculated here, 105,000, and if here any prepaid expenses, those are given here 7,000 and stock 50,000. So just subtract these two and the rest is your quick or liquid assets. And current liabilities are already given here, 20,000. So simply just divide these two, 48,000 divided by 20,000, and liquid ratio is 2.4 ratio 1. The third one is debt to equity ratio, which is equals to long-term debt divided by equity. If it is asked to calculate total debt to equity ratio, then we have to calculate total debt, but only debt to equity ratio is equals to long-term debt divided by equity. But in case of total debt to equity ratio, here formula should be changed, and the formula will be total debt divided by equity, but debt to equity ratio is equals to long-term debt divided by equity. So long-term debts are given here. This 6% debenture is your long-term debt. So your long-term debt is 25,000 only. And equity, here is the calculation of equity. If you have share capital, just add it, that is given in the question, 70,000. After that, general reserve, any type of reserve should be a part of equity. So 25,000 is your general reserve and reserve for confidence is 10,000. So this should also be a part of your equity. And after that, if any profit is given here, then you should add to the part of equity, but profit is not given here. So only these three, share capital, general reserve and reserve for confidence, 70,000, 25,000 and 10,000, and your equity will be 105,000, and long-term debt is only 25,000. So 0.238 ratio 1 is your answer for debt to equity ratio. After that, proprietary ratio is equals to shareholders fund and divided by total assets. So these both are already calculated. Shareholders fund and equity both are same thing. So 105,000 is your shareholders fund and your total assets are 150,000. So simply just divide these two and the result is 0.7 ratio 1. So that was the last question of accounting ratios. Till now, take care of yourself, stay safe, stay blessed, and thank you very much, and wait for next coming topic after final accounts, advanced final accounts, and accounting ratio. Thank you.